everyone. Today we are going to discuss an important concept Capm, that is capital asset pricing model. It is one of the method for cost of equity calculation and also a relevant topic coming under the subject portfolio management. Okay, so let's try to understand what is Capm. All of us know the fact that diversification of securities will help to risk reduction. But even after diversification of your investment, some level of risk will always exist. So naturally, investors seek a rate of return that compensate for that risk. So Capm helps to calculate investment risk. The model was introduced by Jack Trainer, William Sharp, John Linder and Jan Mosin, independently building on the earlier work of Harry Markowitz. Investors should be compensated for the time value of money by means of risk-free premium. What is risk-free premium? Risk-free return, it's a theoretical return. That is, it's a guaranteed return with zero risk. It is the return from an absolutely risk-free investment. Okay. So first method is he should be compensated by way of risk-free premium. And second method, the investor should be compensated for bearing risk by way of risk premium. What is risk premium? It is the investment return, but in excess of the risk-free rate of return. Okay. It's a form of compensation for investors for bearing risk. That is, it's an extra payment to investors for tolerating the extra risk. Capm model, that is capital asset pricing model, holds that investors have to be compensated both in terms of risk and time value of money. Capm shows the return of a security is equal to the risk-free return plus a risk premium. It is a model that describes the relation between risk and expected return. And this model is widely used in the pricing of risky securities. Before going to discuss Capm, that is capital asset pricing model, you should be aware of what is risk and what is return. What is risk? It's a term refers to the variability of actual return on an investment from the expected return. So we can classify risk into two types, that is systematic and unsystematic. First one, systematic risk. Systematic risk is also called undiversifiable and unavoidable risk. Why systematic risk is called undiversifiable or uncontrollable or unavoidable? It is the risk of the entire market as a whole. So it arises due to factors like economics, sociological, political, etc. So it is a non-diversifiable risk. Okay. Systematic risk is the risk due to system-wide factors. This systematic risk can be classified into three types. First one, market risk. Second one, interest rate risk. And third one, purchasing power risk or inflation risk. I will give you a brief explanation about what is market risk, interest rate risk and purchasing power risk. Okay. So what is market risk? It is the variability in stock prices due to changing investors' attitudes and expectation. And secondly, interest rate risk. It arises because of the change in value of security prices due to change in the interest rate prevailing in the market. And thirdly, purchasing power risk. This type of risk arises due to inflation. That's why it's also known as inflation risk. I have already uploaded one video regarding the types of inflation while discussing international finance. I have put the link in the description, so if you want to know, please watch it, okay? Here we need to discuss two types of inflation, that is cost push inflation and demand pull inflation. What is cost push inflation? It is the inflation due to rising cost of production, and the second type is demand pull inflation, that is if inflation occurs due to the excess demand for goods and services, it is called as demand pull inflation. Clear? This is the classification of systematic risk. So let's discuss what is unsystematic risk. This unsystematic risk is a risk of an individual company or industry. So it is unique to that specific company or unique to that industry. Okay. So it is diversifiable. So that means it can be avoidable or we can control that type of risk. Unsystematic risk can be divided into operating and financial risk. Therefore, total risk includes both systematic and unsystematic risk. But Capm considers only systematic risk. This systematic risk is measured through beta. So this beta is the risk measurement factor. If beta is equal to 1, it indicates lesser risk, that is less risky than average. And if beta is equal to 1, it is market risk, that is the stock is average risk. If beta greater than 1, it indicates very risky. Therefore, according to Capm, the non-diversifiable risk of an investment or security or asset is assessed in terms of the beta coefficient. Here you have to note the point. Here we measure only non-diversifiable risk. What is non-diversifiable means? That is, it is unavoidable or uncontrollable. It means systematic risk. That is, Capm measures only systematic risk. Okay. Here the assumption is that an investor can reduce or eliminate the diversifiable risk through diversification. Okay, so we can eliminate diversifiable risk. Here diversifiable risk what? That is unsystematic risk. So unsystematic risk can be eliminated through diversification. Clear? I repeat again. Capm considers only the non-diversifiable risk that cannot be eliminated. This non-diversifiable risk is assessed in terms of beta coefficient. Clear? Okay, let's discuss a problem. Stock beta is 2.0, the risk-free rate is 3% and the market rate of return is 7%. Here we are using Capm. Therefore, the formula is K is equal to RF plus beta into RM minus RF. So here KE is equal to cost of equity capital, RF is equal to risk-free rate of return, beta coefficient, then RM rate of return on market portfolio, then RM minus RF, that is the market premium. So here beta is 2.0, the risk-free rate is 3% and the market rate of return is 7%. We have to find out RM minus RF. Here RM return from market portfolio, that is 7%, and RF risk-free rate, how much? 3%. Therefore RM minus RF, that is 7% minus 3%, we get 4%. While applying the values in the equation, we have to multiply the market return by the beta. Market return here 4%, then 2 into 4%, that is 8%. Therefore, excess return of the stock will be 8%. Finally, the answer would be 11%, that is 8% plus 3%. That is the stock's excess return plus the risk-free rate. Okay. So, thank you for watching the video. Bye-bye.